Good afternoon, and welcome to the 2010 Norman A. Sugarman Tax Law Lecture, sponsored by the Center for Business Law and Regulation here at the Case Western Reserve University School of Law. This lecture and the Norman A. Sugarman Tax Scholar in Residence Program was established by a generous gift from Mr. Sugarman in 1976. Norman Sugarman was an eminent tax attorney and alum of both Adelbert College of Western Reserve University and our own law school. He served as, and this I found particularly interesting, the first assistant commissioner at the Internal Revenue Service after it was reorganized in 1952, in addition to other positions at the IRS, and also was a member of the firm of Baker and Hostetler. And we are honored to continue this program, this lecture series, in his memory, given what he's meant to the school and to the broader legal community. This year, we're really pleased to have back with us John Tiley as this year's Norman A. Sugarman Tax Scholar in Residence and Lecturer. He is the Emeritus Professor of Tax Law and Life Fellow at Queen's College, University of Cambridge, where he has taught since 1967. Among other things, he has directed the school's LLM program, was founding director of the Center for Tax Law, is the author of Britain's the leading British tax law treatise, Revenue Law, and numerous articles on tax law, and has a particular interest in the comparative law of tax. I could go on. You have his bio, and you came here to listen to him, not to me. So let me just note, he has been a visiting professor here at Case in the past, has also delivered the Norman Sugarman Lecture, I believe, in 1985. We are very pleased to have him back with us again. So without any further ado, I will turn it over to Professor Tiley, who will talk to us about tax avoidance, the never-ending search for resolving clashing principles.
Thank you very much for that introduction. Good evening, ladies and gentlemen. It was indeed 25 years ago that on 1 week's notice I gave the Sugarman Lecture downtown because the real highlight of the year, a visit by somebody very distinguished from Washington, had to be cancelled. This year I've had 1 year's notice, and therefore the talk will be nothing like as good. I remember it was about 20 past 1. I stood up to give my address, and Bill Timogin said to me, "You can say anything you like as long as you finish at 5 to 2. And I've used that to introduce lectures around the world ever since. So thank you very much, Bill. Nice to see you again. I have put a handout around, and we shall follow this, and I have a certain timetable that I must try and keep to. On the very first page, we've got some sources. You will see that Professor Johnson is cited there. Professor McMahon from the University of Florida, and then a very important work prepared in the United Kingdom. We have a body called the Institute for Fiscal Studies, and it is wonderfully independent of every political party that there is in the UK. And this gives its work an authority, which all political parties like to seek as elections come round. Fiercely independent, it has a tax law review committee, and we spent about 2 years looking at the problem of what to do about avoidance. And our report is there and is available online for those who can do that advanced sort of thing. In the last year, we've had a code of practice on the taxation for banks in the United Kingdom, which I shall mention. And very recently, last month, we had the avoidance disclosure statistics. So there are some of the things I should be citing. And then it says, prologue, avoidance, not just a tax issue, tolls. And this is the archetypal avoidance case. Once upon a time, there was a man who was a farmer, and he drove his cattle along a road in England across which there was a toll bridge. And as he went past it, he had to pay a toll. As he owned the land adjacent to the track on one side of the road, he then built himself a gate just before the toll, gate on the other side, and proceeded to drive his cattle up to the gate, then smartly to the left, smartly along, and smartly back onto the road, avoiding, in all senses, the toll gate. Now, the question for the court was whether that was successful avoidance or whether they should find some ultra-purposive interpretation, which would say that the toll keeper should be entitled to his toll even though the cattle hadn't gone through the necessary gate. You'll gather from the date, 1874, that it is very unlikely that a purposive interpretation would have been adopted, and you are quite right. It's a lovely case. Avoidance, strictest sense. And I owe that to Benyon's statutory interpretation, and you will find lots of other wonderful 19th century cases there. The next two paragraphs refer to the development in the United Kingdom of the contract of hire purchase as a way of getting around the Sale of Goods Act. That too is simple avoidance of the sound policy of the Sale of Goods Act. And the reason why I put it on is that this case is actually referred to in the very famous Duke of Westminster case, which was our most ferocious pro-taxpayer avoidance decision from 1936. So there we are. It is not just tax. Then on page 2, we come to the title. You have been reminded of the title. Tax avoidance, well, we know what that is. Well, up to a point. The never-ending search, that's a pretty good word. Search, because we really do have to work quite hard to find the answer. And resolving clashing principles, because that's what, as tax policy people, we do all the time. There's a wonderful quotation I thought of putting on from Justice Dixon from Australia. He says that we should try to work out the principles of law rather than assigning issues to a residual category of fact. So that's the title I sketched out for Professor Jensen a year ago. And then underneath you have his subtitle, What Can US Policymakers Learn from the UK Experience? And there you have my answer, perhaps not much, but on the other hand, that seems a little bit cavalier. The reason why it's perhaps not much is because of JITSIC, the Joint International Tax Shelter Information Center, based in Washington, has representatives from the United Kingdom, the United States, Australia, and Canada. 2 of those 4 countries have a general anti-avoidance rule. I don't think you do have, despite last week's enactment of legislation, but that's something you can quarrel about privately. And, of course, in the United Kingdom, we don't have a GAR either. And in this talk, I want to move from the heroic days of 25 years ago, when the United Kingdom was finding its way forward to develop jurisprudence to control tax avoidance. From those early heady days, we now have a plethora of devices, as you have, a whole variety of techniques with which we try to manage avoidance rather than solve it. And as Professor Jensen says in his article, which I have referred to, this is the case here too. 1985, a retrospective with thanks. In 1985, I came to this law school to do some research on your doctrines. We had just, in the United Kingdom, had a case in which 6 cases had been cited to the House of Lords, and on the basis of that, they were invited to decide that we should adopt substance over form. I took the view that that would be a rash thing to do, but I wanted to come over here and find out how you actually did those things. And so, with the help from the young Professor Jensen, the ever-young Professor Gabinet, Professor Karen Nelson-Moore, and a team of adjuncts to die for, I had a wonderful year. At the end of it, I wrote a series of articles for the British Tax Review, on the basis of which the House of Lords decided they were not going to go down the wholesale adoption of your rules. But there's a bit more to the story than that. The problem, this is a quotation from Professor Jensen's article, a quotation from Professor Gratz, you can find there. What is a tax shelter? It's a deal done by very smart people that, absent tax considerations, would be very stupid. And this is a nice way of breaking in non-tax people to what we get so excited about. The next few lines contain our great UK case. C has a taxable capital gain of £170,000. C wants to create a loss to set against it. C, who has no relevant money, borrows money and buys shares in X. Those shares will generate the loss. C, who still has no money, borrows money and makes two loans of £217,000, both at 11% interest, fair rate at the time. Under express powers, C increases the interest rate on one loan to 22%, and as a result, the rate on the other loan drops to 0. All interconnected, all choreographed. A loan at 22% is now rather valuable, and it's sold for full value and gets a gain, and it has a knock-on effect on the shares, which thereby generate a loss. And the taxpayer presents the tax authorities with two tax packets: the loss on the share, which he wants to use, and the interconnected gain on the loan, the same amount, which he wants to say shouldn't come into account at all. And he says the gain on the loan is not taxable because we have an express provision in our tax law which says neither a taxable gain nor an allowable loss can arise from the disposal of a debt. As Professor Jensen points out, the taxpayer wants a literal interpretation, and for many years in the United Kingdom he might have expected to be able to get away with it. But not so. The United Kingdom stopped this by case law in 1981. The reason is, if they hadn't stopped them, then the tax system becomes optional. You either pay the advisor or you pay the revenue. And that's not a very good deal for revenue's point of view. So it was, it's optional, provided you can pay enough, usually a small fee and a percentage of the tax saved, and it was a condition of buying the scheme that you delay the claim for relief until the last permitted date. How to stop it? Composite transactions, series of transactions. And of course that was what was lying behind the idea that we might import your doctrines on their heroic scale. And there I put over the page in the heavy type Boris Bitker's description of this. These presuppositions or criteria are so pervasive that they resemble a preamble to the code describing the framework within which all statutory provisions are to function. Well, I didn't like the idea of transferring bleeding chunks of alien doctrine into the United Kingdom tax law, and I also thought that your constitutional arrangements were rather different. And I'm very pleased to report that in 1988, the House of Lords thought the same. Unfortunately, they did not cite the relevant academic articles, so there was no reference to Case Western or the wonderful work that you had enabled me to do. But it is, they're much better at it now. In those cases, they didn't, in those years, they didn't do that. Well, the current state of play on our domestic tax law, case law, our new approach is firmly based, as yours is, in purposive construction, except when you don't adopt purposive construction. And we've had a series of cases where the revenue have won. We look at the reality of the situation. We look at this in a wide-ranging and purposive way. The difference between the issue price and the redemption price had to give rise to a possibility of making a gain that could be objectively seen to exist. And this security never had that possibility. It was a practical certainty there would be a loss, and therefore this did not qualify, and the taxpayer's scheme fell apart. That is a recent case called Astral. It's just been in the Court of Appeal, as you can see. More interesting, perhaps, are the cases where the revenue has lost, and we find these on page 4. The first is where the taxpayer and his advisors have found a gap or an asymmetry between two pieces of legislation. And this was so in the Darcy case in 2008. And there's a nice quotation from the judge. What the revenue were really complaining about was that one scheme, called the accrued income scheme, and the other bit of legislation, called the manufactured payment scheme, were not one coherent set of rules. Absolutely right. They're not one coherent set of rules. And one would like to think that more of our sets of rules were coherent, but that's another story. That did not entitle the court construe the section in the accrued income scheme to fill the gap. You would think would probably reach the same conclusion. Then the second case, which is also 2008, a taxpayer was facing a rule turning a capital payment to an income payment, but ensuring that the payment accrued not to himself, but to another entity, a company not resident in the UK, and so not liable to tax. And here is this disarming passage. Council didn't claim there was any fiscal or economic merit in the result which they contend. They simply submitted that the relevant legislation admitted of only one construction, and if the result was not the revenue's liking, then the revenue had only itself to blame. We blame the revenue. The revenue, IRS, I see, blame Congress. And that is a very great difference between our two countries. The revenue had only itself to blame because they control the legislation in my country for procuring the enactment of such complex deeming provisions without giving enough thought to the consequences. Lovely. All right. Now, the next one is very recent. You can't have a purpose of construction if the revenue failed to prove the purpose. And this is what happened in this very recent case of Mays. Mr. Hewitt submitted the overall purpose of the legislation was to ensure that life policies were subjected to the correct amount of tax over their lifetime, rather than ensuring that individual taxpayers paid an appropriate amount. Some taxpayers end up paying more or less tax than is strictly equitable, but over the lifetime of the policy, the correct amount of tax is charged. However, wrong. It seems to me that Mr. Hewitt's purpose of construction assumes that chargeable events will result in a charge to tax, and that overall, at the end of the day, the correct amount of tax will be exacted. Neither of these assumptions necessarily holds good. So, bad luck. Revenue. No purpose of construction. Now, there's another strand to that case, which is the court deciding that a statute is too prescriptive for anything but a literal interpretation. And our famous Lord Hoffman has articulated that in an article in 2005, and you can find exactly the same passage, or the same point, if I'm very clever and find it, in Learned Hand's judgment in the Gregory case. Same passage in Gregory, Judge Learned Hand observed, as the articulation of a statute increases, the room for interpretation must contract. So, we're on the same wavelength. And that is where we are in case law. And I've been looking at Professor McMahon's description of the case law as you have it, and you will find all sorts of things that will be sort of ticking at the back of my mind and maybe ticking at the back of yours as well. Case law is inadequate to give the revenue what they want under our system. Whether it's enough under your system, I suspect depends in part on how much weight one gives to the legislation last week enacting the economic substance doctrine. But I have no wish to intrude into an area of private grief. Now can we turn then to how we manage other ways of dealing with the avoidance problem. This takes us to the Institute for Fiscal Studies review of legislation that I have referred to earlier. After about 2001, when the courts told the revenue that they weren't going to get their general anti-avoidance doctrine from them. And slightly earlier, we have had a number of provisions in our legislation. And if you would like to find this wonderful extra sheet, this is the table which has been prepared to the IFS Tax Law Review Committee report. We don't have a GAR, we don't have a statutory GAR, we don't have a judicial GAR. So, what do the revenue want to do? And the answer is set out on this page. They give us lots of mini GARs. There are, I think, 22 variant forms of a GAR or mini GAR in our legislation. We also have what we call TARs, or targeted anti-avoidance rules. And because you can see at the very bottom of the page, if you're very good at arithmetic, and I'm hoping that I've got it right, we have 104 GARs and 60 TARs over that period. Well, that's one way of dealing with avoidance. The cost is that your system, our system, is getting more and more complicated. It works, but at what cost for the complexity of the system? These are not easy provisions to understand, and quite often they need extensive guidance from the revenue when these things are promulgated. And that raises further problems about the extent to which you can rely on the guidance, especially when the guidance changes. What this has to do for the stability of a system is a matter of some concern to some of us. And that is why in the United Kingdom at the moment we are getting increasingly worried about the international competitiveness of our system. We are being told by business people that we should be worried about the international competitiveness of our system, and they have a string of suggestions for reform, usually to advance their own interests. One of those, which we enacted last year, was that we joined the majority of the countries in the world which do not tax foreign dividends and corporation tax. UK tax, we don't levy UK tax on foreign dividends, assuming that we've got the strong enough holding, not just portfolio dividends, exemption from the UK for foreign dividends. It's partly driven by the European Court of Justice, but only part. The real thing was the international business people in London said, look, you may lose our business to Dublin, Estonia less likely, Switzerland, places with good golf courses, good banks, good lawyers, and a well-trained workforce. As all those other factors become more and more even across the world, the tax stands out more and more as something that they are worried about. So we made that change last year. And it's in a way making up for, but does not address the issue of the stability of the system or its inherent complexity by the time you've had all these rules drafted in. What we did on the committee was to ask whether a wide-ranging GAR, this is not a mini GAR, this is an all-embracing GAR, which we drafted in 1997-98, would have meant that there was no need for these TARs. Now, the answer to that is not completely helpful. What we did was to ask whether a GAR in the form suggested in 1998 would have done a better job of tackling this. But the purpose of our review as it worked out was to draw attention to the extent of anti-avoidance legislation, which is just done by numbers, and the limits of a general anti-avoidance rule. What we found was that a GAR might assist in countering some transactions, but certainly did not always provide the answer. And therefore, if you go down the GAR route, you're going to have a lot of these other things as well. But again, it began to get a bit more difficult than that. We realized how blunt a tool a GAR could be. At times, it seemed clear that a GAR should not apply. But in fact, coming within something called the protected transaction definition proved to be very difficult. And what was driving that was that the taxpayer could rely on another bit of the tax rules, a clear provision or exception, which excluded that liability, but that was not an exception to the anti-avoidance rule. And if you ever go to Australia, you'll find that they have exactly the same problem of the interaction between the wide-ranging GAR, which applies after you have done all the purposive construction that you can think of under the rest of the Act, including all the TARs and everything else. At the same time, GAR would not apply when the transaction had all the hallmarks of a tax avoidance construction, a tax avoidance transaction. But it could be argued that it was encouraged. So what we found was that the wonderful thing we developed was difficult to apply. It was all done with goodwill. It wasn't done out of malice. It really was quite an interesting exercise. We had the business people, academics and economists and everybody sitting around. And we agreed that the more we looked at these things, the more difficult it became. The other thing that came across very clearly was that the meaning of tax avoidance to Her Majesty's Revenue and Customs at any rate had changed. Many more transactions, which previously would have been regarded as planning, suddenly were treated as avoidance. Once you get into this mode of saying, oh, we must do something about avoidance, it's very difficult to stop yourself, especially when, as in the UK, you can act what you want whenever you want to. It wasn't all negative. We found that a GAR could replace many of the more general TARs, but we also found that in many cases, as it says on the table, TARs have been drafted with fewer motive or purpose limitation, and what the TAR was going to do was to give you a much better overall solution to the particular problem. What we would find, though, at the end of it, or might find, is that a GAR would stop some of those cases which I've just looked at, where the revenue moment lose in the courts. All right. So that's mini-GARs and TARs. Principles-based drafting. Everybody around the world is looking at this, and everybody is wondering what to do. We have two reasons for doing it. One is we think it would help with avoidance. A quite separate thing is that we think it would make the tax legislation as such shorter and better. If you are able to produce good principles-based drafting, then you are able to have something where you can see more easily what the law is trying to do. Problem is that you then have to have lots and lots of non-legislative guidance as to what the revenue think the principles-based drafting might lead to. So we love it until we get to the detail. How is our tax system going to work? So there is our first ways of dealing with the avoidance problem, other than begging the judges to be incredibly purposive. The second is that we have a statute, as you have, we have a statutory duty on various people to report tax avoidance schemes. And I've been reading what Professor Jensen had to say in his chapter, and I agree with everything that he said about it being, on balance, a good thing. It's been extraordinarily influential in the UK. Every year, about a number of these provisions are based on schemes that have been reported to the revenue. And they thought, oh, yes, we better do something about that. And of course, what they're doing is acting early enough so as to prevent the tax system hemorrhaging a lot of money. The revenue provide, I must be careful about the revenue provide a spotlight list of schemes that it intends to challenge in court, not necessarily dealing with it by more legislation. Now, who likes this? The revenue like it. Her Majesty's Revenue and Customs think that this has the advantages of a GAR without having to have a GAR. Enacting a GAR is extremely difficult, as you can see perhaps from one or two of the things I was saying earlier. It's very difficult to apply. But there's another reason why they like it. We don't have a ruling system. We think that if we had a GAR, we would have to have a ruling system to make it fair, and revenue would much rather not have a rulings system. And they have given evidence on this to one of our committees in the House of Lords, and their reasoning runs like this. If we give a ruling and we turn the scheme down, fine. People will come back next week with a slightly different scheme, and then tweak it, and eventually we will say yes, and then suddenly we've created a great hole in the tax base. The rest of us say, tough, or haven't you got any confidence in your own judgment, or no, not right, statutorily or constitutionally. If taxpayers are going to be protected, they should be given the right to having a rulings scheme. Of course, in the other countries in JITSIC, there are ruling systems. But this is a major worry. When we were devising our GAR, we thought that a ruling system was inevitable. But as you can just gather, that at the moment is not the revenue view. At the moment, they don't have to do it because they're getting all they want from the duties to report tax avoidance schemes. And so, the one I really like, retrospective legislation. You thought it worked, did you? Then you did it in 1976. 2 years later, we got a little surprise for you. 1978 Finance Act indeed has a provision on commodity straddles, losses arising from all the way back to 1976. That stopped the avoidance. My goodness, it did. We haven't yet reached the Ramsey case, and this was the first real attack by the revenue on the avoidance industry, and it was beautifully effective. More recently, in 2004, we had a lot of planning going on in employment tax law and securities, shares and bonds and things. And they tried 2 years running to get that right. Clever people in the chambers and everywhere came up with more and more schemes, and so the revenue said, you do it one more time. We will pass retrospective legislation. And exactly the same thing happened with inheritance tax and things called gifts with reservation. There, 2 years in a row, And revenue-produced legislation was first of all detailed and then very detailed to counter schemes to get round the inheritance tax rules. And they finally gave up and said, do it once more. We will enact retrospective legislation. It stopped. I mean, it did work, this view of the revenue. So if you want to have an effective way of dealing with these things, that is a way of doing it. There's no doubt that the 2004 changes wouldn't meet our human rights legislation. The 1976 one actually went to the Human Rights Court, the European Court of Human Rights in Strasbourg, and that was said to be all right because it was dealing with avoidance. And it was proportionate. It didn't impose any penalties, it just said you can't get your loss relief. In Europe, we worry at the moment about having one strand of human rights cases coming from Strasbourg and another line coming from the European Court of Justice in Luxembourg. So we shall wait and see whether the 1976 Act would still survive a challenge. If it would, then retrospective legislation is quite a major story in our exercise. We now come to the non-legislative ways of dealing with avoidance. Be nice and polite. Sort of non-legislative things I'm thinking about are, first of all, the guidance that comes out on the new legislation, on the principles-based legislation, or even on the non-principles-based legislation, complex stuff. Revenue produce their guidance, and you have to wade through it. And some of it is very long, very detailed, and very hard to stay awake while you read it. It is not easy reading. Can you rely on it? Well, if the revenue decide not to give you the benefit of their guidance, what can you do? Well, either you can appeal when the assessment eventually comes round, or you can take preemptive strike by seeking judicial review. And seeking judicial review is very expensive and not particularly effective at the moment. So that is a real problem in our system. The next, large companies, customer relationship managers. The revenue, a few years ago, set up a committee to look at the problem of dealing with large businesses. And they came up with this idea that businesses should be entitled to a customer relationship manager in HMRC, that this person would get to know the business, get to know the tax people, get to know the board, and it would be wonderful, wouldn't it, if everybody behaved beautifully. Again, is light touch regulation. The cost is that the revenue are there. What will these companies do? Well, we think that the companies will still go through quite sensible, vigorous, but not too aggressive tax avoidance planning, and they will, under this regime, keep the revenue informed openly, professionally, and transparently, so that everybody knows what is happening. Everything is out in the open, and the revenue can challenge it or not as they wish. These companies are not going to indulge in artificial schemes because their reputation is too much at stake. That is the line that they seem to have taken, and you will see that in the line just above that, OUBTRC report. That is the Oxford University Business Tax Research Group report, where they've done quite a lot of work about how this has been working. I'm actually a graduate of the University of Oxford, and although I spent 41 years in Cambridge, I spent my undergraduate and graduate life in Oxford, and my first teaching job was in Oxford. So I owe both universities a very great deal. All right, next. We've taken over risk assessment from Australia, and we think that the HMRC, when deciding who they're going to go after, go through quite a detailed risk assessment. Banks, well, banks are good or banks are bad? I don't know. We change slightly from day to day. Banks, we have put an awful lot of money into our banks, we the taxpayer. We take it amiss if they're going to go into lots of fancy tax planning. And so we have got a concordat. We have articulated a code of conduct, especially for banks. Banks should comply with the spirit as well as the letter of the law. And we'll wait and see whether that works. It's meant to be that under governance you would find documented strategy, policy which is open, professional and transparent relationship with HMRC. And as far as tax planning is concerned, it will be used only to support genuine commercial activity. And relationship with HMRC must be transparent and constructive and based on mutual trust wherever possible. No. We shall see. Now, the other thing that I was just going to mention, and I was, let me come on to these conclusions. Changes of perception. The HMRC view of avoidance has changed, and it is undoubtedly the case. A lot of things which previously would not have been worth their while are suddenly into the sights to be dealt with as avoidance. And this makes it slightly difficult when you want to argue about the purpose of legislation which was passed some time ago. Within the country, we have shifted on our policy front from equity, which we've had really until 1979 when Mrs. Thatcher came to power. From 1979 until the end of the Conservative government, we believed in neutrality. And since 1997, our policymakers, who all learnt the sum of their business in the Clinton White House, think that the tax system should be used to make people behave differently. Yes, and so it is said that Mr. Gordon Brown has been the best developer of our tax legislation for accountants. We have endless rules. Another point that I thought I would mention here, because I just saw it down in Florida when I was there last week, a new idea that everyone should pay some tax. Yes, it's a wonderful little dictum. But remember the fate of Mrs. Thatcher. She was in power in 1985 when I was last here. Her community charge, which was an effort to make sure that everybody in local government paid something for the services that they received, became the hated poll tax. And what we learnt from that was that fairness trumps all. I think the real urgency, at least in UK tax policy at the moment, is the economy, and the idea that we've got to get our economy competitive, and that means making the tax system competitive and not indulging in our endless attempt to put more and more anti-avoidance rules in. Now that's a view. It's based on a number of sources, and it may or may not chime with you. But that depends on what you want your tax system to do. And of course you want it to pay off your debt, don't you? So do we. All right, questions?
Even though you're a professor, do you ever work as a consultant to establish fancy tax schemes? Even though you work as a professor, do you also work as a consultant to set up any fancy tax schemes?
You mean how expensive am I? I work with HMRC. No, I have been in chambers, and I had a very thrilling time in chambers. One of my pupil masters, a person called Donald Nichols, who went on to be the Lord Nichols of Birkenhead. And the other was a person called Graham Aronson, who has been arguing in all these cases on behalf of taxpayers. So the answer is that I have spent a lot of time talking with people in practice, and I have done some practice on the side as well. But I remain an academic.
Are you aware that in the United States the poor do pay a lot of taxes? Are you aware of that? Are you aware that in the United States the poor do pay a lot of taxes?
Yes.
But are you aware how?
And what we have done is to copy your tax credit system.
No, there's
And
there's
an
another
effort to-
another huge way.
Yeah.
We have a system called the lottery, and that's a huge tax on the poor. No, I'm very serious. You have that in
Our tax on the poor is usually the withdrawal of tax credit. Our marginal rates of tax on the poor is usually about 60–70%. It's a lot better than it was before we copied your tax credit system. And in the old days, we'd be sometimes over 100%. So from that point of view, it's better. But we've still got a lot of tax on the poor which are paid in sales taxes. But we don't have a state, we don't have a federal system. So we only have the one jurisdiction to worry about. And there we have VAT at 17.5%, but not on food. And that is the great issue. If you want to charge VAT properly, should you charge VAT on food? And the answer is, well, the poor need it. But that's the reasoning there. The reason for exemption is...
What did you think about my concept on the lottery being a tax? The concept of our lottery system being a tax on the poor.
Oh. You mean the real lottery system, the national lottery?
Very serious. That's what it is. Maybe you don't. Do you understand what I'm talking about? A lottery where people buy tickets to win.
A real lottery as opposed
Yes.
to fiscal lottery. Yeah.
No. Our real lottery, the poor people are the main buyers of. Our poor people in this country are the main purchasers of lottery tickets. They spend a lot of money on it.
That's voluntary taxation. As
Oh,
opposed to involuntary.
it's voluntary? You mean? I'm
Question.
confused.
Question, please.
In the back here.
Question. Who is supposed to be reporting these tax avoidance schemes? Is that employees or whistleblowers? And do they get any benefit for doing that? What's their reward?
The reward is that if they fail to do it, they're subject to penalty.
I mean, are people really penalized?
This is reporting, notifying your scheme. Right?
What if they don't do it? How do they find out? How does revenue find out?
Who has the obligation to provide service?
The accountant, you mean?
Not lawyers, because they have their own profession. If you devise a scheme, it's different here. Who notifies your avoidance scheme?
I think
the taxpayer at the end of the year. You say, I've used the scheme.
Like the IRA.
No, what she's saying is that ordinary citizens and taxpayers are given a reward for informing on a tax avoidance scheme. She's asking the question, is there something like that over there?
Not. If you have someone who you think is cheating devising an avoidance scheme.
I had a question. On a global level, I recall about 10 years ago there was a famous World Trade Organization case, Foreign Sales Corporation case, dealing with subsidies and foreign income being double taxed. And the U.S. was setting up, corporations setting up tax shelters. I'm wondering what has happened on a global level with UK and US dealing with that issue. I think you made reference to with.
No, I didn't.
Okay, the question is,
I'm familiar with that case.
you're not okay. Okay.
We do have a lottery, but we don't tax the prizes. And I don't know what the breakdown is for people who actually do it.
On retrospective legislation, tax legislation, doesn't that run afoul of ex post facto laws in the U.S. Constitution? How does that play in, or does it at all? Retrospective legislation, tax legislation, does that play into the ex post facto law in the Constitution of the United States? Does that play in at all? Has anybody ever thought of it? Or?
Well, we don't have a constitution, do we? We don't.
Okay, so you're not familiar with that.
Hello? Oh, I have no idea how it would work here. That's your problem. It's your constitution. In the UK, we have a certain protection for property rights under the European Convention of Human Rights. But what the court does is make a balanced judgment about whether the particular rule is proportionate. It says that some retrospective legislation is needed to protect the tax of bail, especially if they've had one go at it already, which is what had happened in 2004, and Parliament comes again. Then the court will say, yes, that's fine. That's what the European Court of Human Rights will say in Strasbourg, yeah.
Questions? I'll take it prerogative to ask one final question. You mentioned at the end an interest in using the tax system for controlling behavior. And it seems that the whole problem of tax avoidance, insofar as we think it's a problem, is that people's behavior is being modified by the tax code. That is, they are engaging, as you said in the beginning, really smart people engaging in things that were not for the tax code would be stupid. How do we balance? Because it seems that the more we want to use the tax code to influence behavior, the greater the problem of tax avoidance potentially would become.
And the greater the problem is that the government encourages something and you do it. How can that be avoidance? And the answer is usually because you push the envelope too far, or you bring yourself within the scheme by artificial means. There usually are some sort of residual things like that. But otherwise it is very much a matter of saying that if government encourages you to do something like invest in machinery and plant, then indeed you should be allowed to do that. And there are some very interesting targeted anti-avoidance rules in that area. Can I just say one last thing? On one of your handouts it says Mark R. Mark Rains is an old pupil of mine, and he was much involved in the early days of securitization. And he gave us a wonderful day in Cambridge recently talking about all credit crunch and all the problems that had arisen. And the question that he addressed was, how do you stop it? All the absurd behavior in the City of London. Somebody would be sitting at a desk, the issuing house rings this person up and says, we have allocated you £100 million of these wonderful derivatives. yes or no? And you had to say yes. And if you said no, you not only missed on that, but you missed on the next issue, and you'd lose your job because your employer would want to know why you hadn't said yes. It was a crazy, crazy world. And the question is how to stop it. And we asked Mark, well, wouldn't some nice detailed rules do? You give me detailed rules, I'll find a way through. You give me a principle, I'm stuck. And that's why principle-based legislation is attractive, but the cost is that you have to have lots of other information to help get it to work.
We have a small token of our appreciation for Professor Tiley to take back with him. So there's something heavy inside. Please join us for a reception. It's just on the other side of this wall. So if you go out the doors and go around, we'll have a reception in the rotunda just following this. Thank you again very much.